This episode is supported by LoopNet. LoopNet listed properties are 283% more likely to lease or sell. That's 283% more likely to find a tenant or buyer when listed on LoopNet. Help your commercial property be seen by the right audience at the right time in the right place. Be seen on LoopNet.
Capital investment levels have been high for both REITs, and we expect them to remain elevated. Over the last 3 years, annual investment by Digital and Equinix averaged 5.5% of their gross asset base, which is high. Both REITs, however, demonstrated good ability to raise capital at healthy pricing through different credit cycles and strong leasing execution for the properties being built.
Hello and welcome to the REIT Report. I'm your host, Sarah Borgson-Keto. Today we're looking at the outlook for REITs active in the data center sector with my guest, Ranjini Venkatesan. Ranjini is Vice President and Senior Credit Officer at Moody's Ratings. Ranjini, thanks for joining the podcast today.
Happy to be here.
So can you start by sharing your thoughts for the data center sector more broadly over the next 3 to 5 years? And what are some of the forces that you see playing an essential role in shaping your outlook?
We expect demand for data centers to remain strong over the next 3 to 5 years. This is because of the digitization of our economies, data storage requirements from the cloud providers, and massive computing needs related to AI. While the AI-related momentum is a more recent phenomenon, the other segments such as cryptocurrency, gaming applications, social media, and content distribution have been driving growth over the last few years. In a recent report, we had mentioned that we expect data center capacity to double by 2028 to meet the demand. And in that forecast, we had assumed no material permitting delays, no constraints on projects because of lack of power or water availability, and modest improvement in energy efficiency. Over the longer term, we expect technological advances will improve energy efficiency and computing power, which would limit demand for additional capacity, even though the volume of data that needs to be stored will continue to grow. Hyperscalers such as Amazon, Google, Microsoft will continue to take up a large amount of space, and these companies will own and operate their own data centers and also lease space from third-party landlords to gain quick market access and in situations where there are resource constraints. We estimate that the investment in new data center capacity will be about $2 trillion over the next few years, and it will be invested in data center buildings, backup power, in servers and computing equipment, and to add new power capacity to run these data centers. We also expect that landlords and sponsors will raise capital from multiple sources, including banks, corporate credit, project finance, CMBS, ABS, and private equity.
So Moody's rates 2 data center REITs, Digital Realty and Equinix. How are they positioned to address this growing demand?
We believe that both the REITs are well positioned to benefit from the strong demand. They have long track records in this business. They own large, diverse portfolios, which will help them maintain market presence even as competition increases. Both Equinix and Digital Realty have been in the business for 2 decades or more, and they have been investing globally for a long time. In fact, their development pipelines include more investments in EMEA and APAC than US. So we expect geographic diversity will increase as time goes on. They also have very diverse tenant rosters, and the tenant mix for Equinix is more diverse than that of Digital Realty because Equinix has focused on the retail co-location segment for a long time. In comparison, many of the new players and other competitors who are entering the segment are leasing their data centers to hyperscalers and other large tenants, which increases their tenant concept risk. In terms of portfolio strategy, Digital Realty has always owned a higher proportion of its assets, over 80%, compared to Equinix, which owns about 2/3 of its portfolio and leases the rest from third-party landlords. Over time, the share of owned assets in Equinix has also grown. It used to be closer to 40% in 2016-17, and the REIT has building many of its new projects on its own.
And what is your assessment of the capital investment plans of both REITs and the impact of their credit profile as they address the evolving technology needs of their clients?
Capital investment levels have been high for both REITs, and we expect them to remain elevated. Over the last 3 years, annual investment by Digital and Equinix averaged 5.5% of their gross asset base, which is high. Both REITs, however, demonstrated good ability to raise capital at healthy pricing two different credit cycles and strong leasing execution for the properties being built. We expect that they will continue to substantially release their large development projects, and they are increasingly using unconsolidated joint ventures to invest in the hyperscale opportunity. That investment plan is interesting because what the REITs are doing is they're taking minority interests in the unconsolidated joint ventures. They have a large financial sponsor. And because it's unconsolidated, the revenue and the asset base and the income growth in their GAAP reported financials is not as large as their peers, will not be as large as their peers. But taking this route with another sponsor helps them manage liquidity risk because they do not have to independently raise large sums of capital, and also helps maintain leverage metrics even if the projects are funded with a high proportion of debt. The REITs also collect fee income for developing and managing these assets in addition to their promoting. Therefore, we expect for both REITs, the credit metrics to remain at about current levels over the next 1 to 2 years. They will be able to grow their revenues and maintain margins. And because of pre-leasing and use of unconsolidated joint ventures, then leverage levels will remain where they are today, and fixed charge coverage ratio will not deteriorate despite higher rate refinancings.
This episode is supported by LoopNet. LoopNet listed properties are 283% more likely to lease or sell. That's 283% more likely to find a tenant or buyer when listed on LoopNet. Help your commercial property be seen by the right audience at the right time in the right place. Be seen on LoopNet.
And both REITs have a large global presence. Are there particular global markets that present the strongest growth potential right now?
They have a long track record. They have a global footprint. They have relationships with our hyperscalers that they've nurtured over the years. We think that'll help them win business as the tenants go into new markets. The tenants are looking to grow in new markets because there's a lot of data that's being created in those locations that needs to find a home. And so it's an interesting growth opportunity for them. In some instances, tenants are also going into new markets because of data sovereignty rules. These rules mandate that data generated within a country or region has to be stored, processed within the borders rather than in centralized locations. So there are new data centers being built. And as the hyperscalers and tenants are looking for center capacity, as well-established players with proven track records, Digital Realty and Equinix stand to gain.
What about the questions over the environmental impact of data centers? How are REITs addressing these challenges?
It's a great question because environmental impact of data centers has always been an important consideration, both from the angle of the regulators and the tenants. Very simply, a data center needs reliable, uninterrupted, round-the-clock energy, and data centers rely on the local power grids to meet their energy needs. Many of the tenants, especially the hyperscalers, simultaneously have outlined ambitious goals to procure energy from renewable sources. What they are doing is signing PPAs with large renewable developers and investor-owned utilities to offset the energy they procure from non-renewable sources. The other angle is that regulators are assessing the impact of data center projects on their utilities and resources. The three often cited examples, the actions by the governments of Ireland and Singapore and utility provider in Virginia to hold or pause new data center development. Some of these decisions have been reversed, but given the scarcity of resources, the risk of regulatory scrutiny and constraints on development is very real. In this environment, we see Digital and Equinix, other sophisticated landlords, are investing in sustainable data center designs and trying to increase their share of renewable policy.
You touched on this a bit earlier, but we have seen other REITs start to enter the data center space. Is there enough demand for additional competition?
There are many new players in the data center segment. We're seeing landlords who have owned other types of commercial real estate now building data centers. Some of the most significant examples within the Moody's rated CRE landlord space is American Tower's investment in CoreSite that was done in late 2021. Iron Mountain, the document management company, is expanding its presence in the data center segment by building new data centers. And more recently, Prologis, the large industrial landlord, has announced plans to build data center. There are other large competitors too, including CyrusOne, QTS, Switch, entities that were acquired by private investors in 2021-22, who are also ramping up their portfolios. Given the demand forecast, competition is bound to increase. However, we think that most of the new competitors will focus on the hyperscale segment because it is really difficult to build a large, geographically diverse data center portfolio that's also leads to a diverse database. So they're likely to go with the hyperscale route.
And finally, are there any particular issues or trends related to the data center sector that you expect to be following in the months ahead?
The surge in demand and the prevailing supply constraints is fueling rapid growth in capacity, some of which could become redundant over the long term. So while we believe that in the near term, lease renewal risk will be low, it will increase as the market evolves. We are trying to do our best to understand long-term leasing prospects for specific projects and portfolios in our analysis of these investments. Technological developments have always been an important consideration for looking at this sector. They could alter the outlook for the sector at large or for individual properties. For landlords, they need to upgrade their assets, especially as it relates to energy efficiency and cooling upgrades. And some of those are expensive, but they are also necessary to avoid obsolescence. And lastly, and quite importantly, capital investments will remain high. We will be monitoring investors' appetite for DC paper.
Great. Ranjini, thank you so much for joining the podcast today.
Thank you.
To our listeners, if you enjoyed this episode, please subscribe or leave a review on your favorite podcast platform.